in order to keep the system going, they can't let money supply decline. But they've let money supply decline, which tells me the plan is to tank the entire credit system. And that's how you will own nothing. The you'll be happy part, I don't know what they're going to put in the water or the air, but that's how you'll own nothing when credit collapses.
You're watching Silver News Daily. Like this video and subscribe to the channel for the best news that you don't want to miss. Now let's get straight to it.
Imagine a world where silver prices catapult beyond your wildest dreams, reaching heights of $2,500 and even beyond. Sounds like a fantasy, right? But the signs are all around us, hidden in plain sight. The recent surge in gold isn't just another blip on the radar. It's a beacon signaling a future where silver doesn't just rise, it explodes. And with whispers of the banking system teetering on the edge, and the pivotal gold and silver ratio hinting at untapped potential, this isn't mere speculation. It's a treasure map for the future, a call to action for every silver stacker out there. The time to stock up is now, while the door of opportunity is still wide open. Stay tuned as we unveil a compelling journey silver is about to embark on, and why you too should be paying attention. Don't forget to hit that subscribe button for more insights that could redefine your financial horizon. Are you ready to dive into the silver saga? Let's get started. Before we get going, let's take a look at how the government's best and brightest are solving the nation's debt problem. Subscribe to stay up to date on their groundbreaking work.
Silver is at all-time lows on the silver exchange right now in London. It's never been lower. The London Silver Exchange is the lowest ever. 70% of the registered silver is drained out of the COMEX in the last 18 to 19 months. Again, Andy has talked about this brilliantly. And, keep in mind that, many of us who follow precious metals know that only 0.5% of global financial assets are in gold, for example. As you see the COMEX draining out, it's a one-way street, as Andy said. It is a one-way street. It doesn't just refill. But if, the vast majority of private wealth management offices, banks and advisors and fund managers ignore gold because you can't churn it, you can't get fees off it, you can't spin it like you can risk assets or bond jocks on what were the prop desks at the big banks and now at the smaller banks flowing money. Physical gold is a finite asset of infinite duration, but it's 0.5% of global financial assets. Now the 4-decade mean is 2%. So just think if we revert back up to the mean of 2% of financial assets being in gold, that's a 4x increase in demand, which I think mean reversion goes up and down. Mean reversion on the stock market means it's heading way down. Mean reversion in gold assets means it's heading way up. So as markets hit all-time highs that no one believes in because they're nosebleed highs and they're unsustainable, and global central banks are stacking gold and fiat currencies are losing purchasing power, that 0.5% is going to revert back to a mean of at least 2%, and just the demand increase alone, just to revert back to its mean purchasing or mean allocation levels, is going to be another massive tailwind for gold. When you combine that with the one-way emptying of the exchanges in New York and London, as exchanges in Shanghai and Moscow gain more momentum among the BRICS to settle trade agreements among the BRICS nations, to net settle in commodities like gold as opposed to US dollars, there is a seismic shift happening in global markets. There is a seismic shift happening in de-dollarization. There's a seismic shift happening with the DXY, which has gone from 115 to 104. If the DXY dips below 100, that's another key trading range for the dollar. And as gold hits 2100, that's another key resistance line broken. So all these things are happening simultaneously, and they all can be stovepiped into 40-minute conversations on each one of those, but they're all fascinating. And they're all ultimately bullish for gold. Again, doesn't mean it's a straight line, doesn't mean there won't be mechanizations, black and white swan events in between now and then, but it's fairly clear that the combination of de-dollarization, the combination of debt levels, the combination of monetizing the debts, combination of these new exchanges, the combination of the COMEX and London exchanges emptying out their assets in a one-way fashion, and the combination of investors no longer trusting this market top for good. It's burnt into the consciousness now that things are changing. And then you bring in the Main Street recession denial and reality, whether that's in Germany, the UK, the US, China. The world is trusting this new tier one asset, gold, a lot more than the IOUs of government X, Y, or Z, including Uncle Sam. So it's fascinating time. And these stock markets are fascinating. They couldn't be more of a, I think they couldn't be more of a dangerous sign right now. And that's something worth conversation, I think, are talking about as well. It's just these markets.
As we delve into the story of silver's imminent explosion, we begin by unraveling the surge of gold, a phenomenon that's far more than just a headline. It's a beacon of what's to come for silver. When gold prices surge, it's not in isolation. This precious metal's performance is a harbinger, a precursor, signaling shifts in the market that savvy investors watch closely. But why does gold's rise hint at a silver explosion? Gold and silver have danced together through history, their fates intertwined by economic forces, investor sentiment, and market dynamics. As gold climbs, it often leads silver, but with a twist. Silver, with its dual nature as both an investment and an industrial metal, has the potential to outpace gold's gains, driven by factors beyond just investor demand. Consider this. As gold's price increases, investors and industrial users alike turn their eyes towards silver, seeking not only refuge from economic uncertainty, but also capitalizing on its essential role in technology, from solar panels to electric vehicles. This pivot to silver can tighten supply and propel prices, especially when industrial demand remains robust amidst a backdrop of innovation and a green energy transition. The surge in gold is a signal, a whisper of what's possible for silver, echoing through the chambers of the market. It's a call to action, urging us to look beyond the immediate and into the potential that lies ahead. Silver stackers, the time is now to pay attention, to prepare, to act. The surge in gold isn't just another tale, it's the prologue to silver's epic ascent. And as we embark on this journey, remember, this isn't just about watching numbers on a screen. It's about understanding the story behind the surge, the intricate dance of economics and demand that paints a future where silver shines brighter than ever before. So let's keep our eyes on the horizon and our minds open to the possibilities that lie ahead.
So much concentration risk. You can't deny it. And you also cannot say that this is something that you couldn't see coming. You could see 1929 coming. You could see other bubbles coming. I mean, 29, 72, and 2000, you had, 35 times earnings. That was a bubble, the dot-com bubble. We're now at I think the Shiller PE ratio is at 33 or 34. You see it coming. And for those that would say, and I was a hedge fund manager during the dot-com bubble of 2000, 1998, 1999. And I've never been embarrassed to admit that I did very well in that bubble based on one IPO, my one quote unquote NVIDIA of 1999, 2000. It was a pre-IPO that made me an irrational amount of money that I didn't deserve, that no one deserves. But it was the sign of the times. It was a sign of that bubble. I've been through market bubbles. I've seen them. I've literally seen tech bubbles before. I look at the Magnificent Five today, and people say, "No, this time is different than the last one." You had a bubble, but now we have real profits. We have real earnings. This is a fundamentals driven bubble. This is not 2000. Again, I'll say it, and I'll say it over and over. I remember looking at Qualcomm and at Microsoft and at Cisco. These were good companies then. Good companies now. They were just overpriced companies. I'm not saying NVIDIA goes to zero or Facebook. I'm not a big fan of Facebook for a number of reasons. I'm not even saying that Microsoft or NVIDIA go to zero. I'm saying there's just overpriced companies. And you see this over and over. These bubbles start on fundamentals. They did in 99 and 2000, not the IPOs I was in, but the big names on the NASDAQ and the S&P in those days were profitable. But what happens when you get these margins? It's all about expansion and contraction of margins. That's how bubbles are formed. When you're making profits, and gosh knows NVIDIA has been having huge profits in 21. Its numbers went to the billions. It lost in 22 and 23. Its profits were over 19 billion. It's not a non-profitable company, but it's still overvalued. And the advantages it has as the price, cost, and volume are not sustainable. And so when you get a net contraction in the margins, as we've seen in prior bubbles, the bubble will end. I don't know when, I just know how. These are margin-driven, expansion-driven margins that are not sustainable. The sad thing is when you have an S&P this concentrated, and when it does revert to its mean, when it does pop, as all bubbles do, doesn't mean that's the end of those companies. There's nothing left. There's no good narrative left for the U.S., for the U.S. hegemony, for the U.S. economy, because we can get into the recession indicators, the labor indicators, the inflation indicators. There's nothing left. Even the Conference Board lean indicators is saying, well, we're not looking at a recession. Now we're looking at a slowdown because the markets are doing so well. But what is the markets? The markets are five names, highly concentrated, and their cost of capital is different, and their advantages and the margins are not sustainable. So I promise you, it will eventually pop.
Turning our gaze towards the banking system, We find ourselves at a crucial juncture that hints at silver's potential explosion. The tremors felt across the banking landscape are not mere blips, but potential catalysts for a seismic shift in silver prices. It's a scenario where the underpinnings of our financial world could very well amplify silver's ascent to unprecedented heights. Let's break down the fragility of the banking system, a topic that's both timely and timeless. Banks, the behemoths of the financial world, are not immune to the tremors of economic uncertainties. When cracks appear, whether from internal mismanagement, external pressures, or systemic shocks, the ripple effects can be profound. It's in these moments of vulnerability that the intrinsic value of precious metals like silver shines through. Historically, when confidence in banks wavers, investors flock to safe havens. Silver, with its tangible value and industrial utility, becomes a beacon for those looking to safeguard their wealth against the unpredictability of paper currencies and the institutions that back them. But there's more to this story than a mere flight to safety. Consider the role of silver in an economy straining under the weight of its own complexity. As banking instabilities push investors towards precious metals, silver benefits not just from its status as a monetary asset, but also from its indispensability in various industrial applications. This dual demand constrains supplies, pushing prices upward in a self-reinforcing cycle. Moreover, the current state of the banking system, with its vulnerabilities laid bare, could very well be the tipping point. It's not just about protecting assets anymore, it's about seizing opportunities in a shifting landscape. As traditional financial institutions grapple with their own fragility, silver emerges not just as a safe haven, but as a smart strategic choice for those looking to navigate the uncertainties ahead. In this context, the recent banking system tremors are more than warning signs. They're a clarion call for silver stackers and investors alike. The implications of banking instability for silver are profound, suggesting a potential surge in demand and prices that could redefine the market landscape. So as we ponder the future of our financial institutions, let's also consider the role of silver in this narrative. It's not just a commodity, it's a crucial player in a story about resilience, value, and the search for stability in an ever-changing world. With the banking system at a crossroads, the case for silver becomes not just compelling, but potentially revolutionary.
Well, it's interesting, like I said earlier, when you see, again, very respected funds. Look, when I was a family office managing director, there was very few funds that we admired more than Elliott and the Singers, Paul Singer. I mean, this was a fund that you had to wait in line, even with billions, to get into because you so valued their analysis. To see an allocation from funds like Elliott into mining or into gold is a big deal. There, I think, I haven't looked at the actual allocations. We won't know, but Elliott's going into Barrick and Newmont because they see the massive delta between the spot price of gold and the equity price of some of these miners. They see an absolute value play that they're not seeing in the S&P or in the NASDAQ. And again, you've got Druckenmüller and others that are looking at gold, obviously Paul Tudor Jones, other big names. So it's no longer just the gold bugs that are talking about precious metals. But it's fascinating to see those type of names understanding gold because they're really looking at valuations. And you look at someone like Jeremy Grantham in Boston at GMO, another manager that I've allocated to, I'll caveat, so there's a bias there. But Jeremy Grantham's been around. He's seen a few market cycles and a few bubbles before, and he has said that the current S&P is shockingly overpriced. And he's not, again, a gold bug or a gloom and doomer, but he's looking at least a 60% market mean reversion here. I've been talking about an S&P at 3,000 or 2,500 or less for years, not based on being gloom and doom gold pushing or fear pushing, but just looking at understanding mean reversion in the markets. So they are shockingly overvalued. There's the law of physics. For every action, there's an equal and opposite reaction. When you get bubbles this high, this narrow, this concentrated in tech, which is making the S&P effectively a tech ETF, it's 33% of the market cap. By the way, the other 493 names outside of the Magnificent Seven effectively have been profitless for the last 2 years or 3 years. So you really have the 500 market cap weighted stocks. They're supposed to be the best 500 companies in America, but for a small handful are negative returning. So going back to what we've learned from history, and you look at the bigger the bubble, the bigger the reaction, the longer the duration of the pain, the longer that V-shaped recovery doesn't happen. The most classic example, of course, is the Nikkei 89. That was over 34 years ago. It still hasn't recovered its highs in nominal terms, not just in the market, but in real estate and land values. The backdrop for this current bubble right now with the S&P at all-time highs couldn't come at a worse time, because unlike 1989 or the bubble of 2000 or 2008, the subprime bubble or the tech bubble in 2000, we have a debt to GDP ratio that's simply unbelievable and irrational. We have a global debt problem. We have a global recession problem. We have geopolitical problems. The backdrop for a market tanking now, because all markets do mean revert and all bubbles do pop, and this is a bubble, we'll go into why, and why this time is no different. It couldn't come at a worse time. I don't even think Powell likes to see the S&P this high. This is not what we want to see, because this is the last good narrative we have left. We've seen bubbles even the last few years, whether it was in Peloton or Zoom or Moderna or ARKK. Or even IPOs. Those have all
now
dried
let's
up.
delve into the
This is
intriguing
it. This is the
world
last
of the
bubble.
gold
It's the
and silver
Magnificent
ratio.
Seven, which now is really the
but
Magnificent
often
Five, as I
overlooked
believe
indicator
Apple
that
and
whispers
Tesla.
secrets about the future price of silver. This ratio, simply put, measures how many ounces of silver it takes to purchase 1 ounce of gold. Historically, it has served as a barometer for the relative strength of these two precious metals, offering insights into market sentiment and potential shifts in investor behavior. But why does this ratio matter so much, especially now? The gold and silver ratio is not just a number, it's a mirror reflecting the broader economic narratives, inflation expectations, and the investment climate. When the ratio is high, it traditionally signals that silver is undervalued compared to gold, suggesting a buying opportunity for those looking to leverage silver's potential for greater gains. In the current economic climate, marked by uncertainty, inflationary pressures, and shifts in monetary policy, the gold and silver ratio has taken on new significance. As gold prices surge, driven by its safe haven appeal, silver, with its dual role as both an investment and an industrial metal, is poised to benefit. The high ratio indicates that silver could be undervalued, hinting at a correction where silver prices catch up to gold, potentially leading to significant returns for investors. This anticipation of a narrowing ratio is grounded in more than just historical patterns. It's supported by tangible factors influencing the silver market. The growing industrial demand for silver, especially in green technologies like solar panels and electric vehicles, combined with supply constraints, sets the stage for a price rally. As the ratio corrects itself, the price of silver is expected to rise more sharply than gold, offering outsized gains to those positioned to take advantage. Understanding the gold and silver ratio is crucial for investors seeking to make informed decisions about when to enter or exit the market. It's a tool that, when used correctly, can highlight opportunities that others may overlook. For silver stackers, the current high ratio is not just a signal, but a clarion call, pointing towards a future where silver not only catches up with gold, but potentially outpaces it. As we continue to navigate the complexities of the precious metals market, the gold and silver ratio remains a key piece of the puzzle. It's a reminder of the dynamic and interconnected nature of these markets, and a guide for those looking to understand the deeper currents that drive price movements. For anyone invested in silver, paying attention to this ratio could be the key to unlocking significant value, making it a crucial aspect of our journey through the world of precious metals investing.
Well, there's a combination of fundamentals and technicals. There's folks smarter than me who track the technicals. To me, the strength we're seeing today is just the beginning of a much longer book, a much longer bull cycle in gold, not in a straight line. All the fundamentals of why gold is important, not just to central bankers and a few smart hedge fund managers and a small minority of very far-sighted precious metal investors. The world is falling into place. And I say falling, collapsing into place in a lot of ways for gold. That's not an exaggeration anymore. It's not sensational. Managers, hedge fund managers that I admire, and I'll caveat that I've allocated to, like Jeremy Grantham at GMO, understands gold. Druckenmüller understands gold. Paul Singer at Elliott understands gold, and miners in particular in the value play. But they see what we've been talking about for years and has accelerated dramatically since the weaponization of the world reserve currency back almost 2 years ago to the date in 2022. The de-dollarization theme that was fringe and conspiracy theory is now becoming undeniably important. The tier one asset status of gold, the fact that central banks since 2014 have been stacking physical gold at record levels and letting go of U.S. treasuries at record levels. You can no longer castigate those signs and that evidence to the fringe of gold bug, kooks. It's simply the reality of the markets. The policymakers and the mainstream financial media will do their best to continue to drag the I'd say the retail plankton into the whale of Wall Street to chase these market tops right now, and that's fine for speculators. But the simple fact of debt markets, credit markets, and currency markets and their last breaths, not their last breath, but their last breaths, are now becoming more and more undeniable. The words and tricks of policymakers and mainstream media, which is highly corporatized, aren't having the same impact on informed investors and even less informed investors, because regardless of the signposts that are officially laid out there, the realities in front of most Americans and most investors are becoming more and more clear. And it's not just that gold loves chaos and gold will go up as heightened fears rise. Gold loves to punish wayward policymakers and the unwritten or unspoken sins of living beyond our means in debt and debasing our currency and trying to seduce the masses with clever words rather than honest math. And so again, long-winded way of saying the fundamentals are returning because, as Egon, my partner and colleague Von Greyers always says, the best friend, ironically, for smart and informed and long-sighted gold investors is our central bankers themselves, and the Fed in particular. As the Fed becomes more cornered and more desperate, and as the need to issue more debt becomes more inevitable, the debasement of the currency is more inevitable.
As we move deeper into the narrative of silver's potential ascent, we arrive at a pivotal chapter, the intersection of record demand and shrinking supply. This dynamic is not just a momentary imbalance, it's a compelling force that could catapult silver prices into uncharted territory. Let's unpack this phenomenon. On one side of the scale, we have an industrial demand for silver that's not just strong, it's at the brink of setting new records. This insatiable appetite is driven by silver's indispensable role in various technologies that are the backbone of the green revolution. From solar panels harnessing the sun's power to electric vehicles driving us into a cleaner future, silver is at the heart of it all. This year, the demand for silver in industrial applications is expected to hit a record high, underscored by the relentless push towards renewable energy sources and electrification. But that's only half the story. The burgeoning demand is met with a supply that's struggling to keep pace. Mining outputs and silver recycling processes are under pressure, trying to match the market's voracious hunger for this precious metal. This strain on supply is not a sudden development. It's the culmination of years of challenging extraction, geopolitical tensions, and environmental considerations that have made easily accessible silver deposits increasingly rare. What does this mean for the market, and more importantly, for investors and silver stackers? It's a classic economic scenario of rising demand meeting constrained supply, a recipe for higher prices. But in the case of silver, it's not just any price increase we're talking about. We're looking at the potential for explosive growth, the kind that redefines what's possible for the price of silver. This isn't speculation, it's a conclusion drawn from closely observing the market's fundamentals. The green revolution isn't slowing down, it's accelerating, with governments and corporations alike committing to sustainable energy solutions. This commitment translates into a non-negotiable need for silver, pushing its value not just as a precious metal, but as a critical component of our future infrastructure. As we stand at this crossroads, witnessing the forces of demand and supply shaping the future, the message is clear. Silver's price potential is not just optimistic, it's grounded in the very fabric of our evolving global economy. For those looking to invest or expand their holdings, understanding this dynamic is crucial. The surge in demand, coupled with the challenges in boosting supply, paints a bullish picture for silver, making now a potentially opportune moment to consider its role in your investment portfolio. So as we reflect on the story of silver's ascent, let's not overlook the powerful narrative written by the twin forces of demand and supply. It's a story that goes beyond numbers and charts. It's about the essential role silver plays in our push towards a greener, more sustainable future. And for investors, it's a story that could lead to significant rewards.
Hemingway warned about. This is something Rogoff and Reinhardt warned about. These are just the inevitable symptoms of a debt cycle and a fourth turning and a karmic reality for mismanaged central planning, mismanaged central banks and monetary policy since 1971. And it's been slow and steady in favor of gold. Now it's accelerating. Like Hemingway's description of poverty, it starts slowly. We've beaten this up, but it happens all at once at some point. And long story short, that's why gold is starting to hit new highs. These are not the all-time highs. They'll go much higher than this in the future, and that won't be in a straight line necessarily. But between what's happening in the global debt markets, what's happening in the retail space becoming more informed, what's happening with portfolio managers becoming more informed, central bankers becoming more informed, I think even these market bubbles, which we can talk about, are starting to seem surreal even to the speculators. So there's just so much happening in such a strange way that all, I think, bode very, very well for physical gold. And what's happening, we can talk about too on the COMEX or the silver markets or the gold markets and the London exchange and the New York exchange. It's historical right now. So they're all signposts that things are not the end of the world, but things are cracking in undeniably obvious ways. Line of resistance, you would normally expect, and I hate to say it, the usual suspects in the COMEX to start putting a boot to the neck and sending out large paper shorts to kind of artificially manipulate that market. The reality that we're seeing right now, for a number of reasons, way past Basel III, is that COMEX has less and less ammunition and less focus on gold and silver right now. First of all, they're simply undeniable, really fascinating things happening with Andy Schectman, who you know very well, has talked very brilliantly about and has been tracking. He's been tracking for years, but is always one step ahead of what's happening on the COMEX and the silver markets and the gold markets there, and also in the silver and gold exchanges in London. I mean, again, he made the comment the other day about JP Morgan, in the past had almost a nearly $1 billion fine for the sin of manipulating the gold price, which they are not alone in doing. And now they've got, I think, 45 million ounces of gold off their books, but in their coffers, so to speak, another 1.2 billion ounces of silver. So what they're doing behind the scenes with an asset they used to manipulate, they're now stacking, just like the central banks in Saudi Arabia, China, Russia, India, and other.
As we delve further into the unfolding story of silver's potential, we come across a critical chapter shaped by monetary policies and their profound impact on precious metals, particularly silver. This segment is not just about dry economic policies. It's a pivotal part of understanding why silver's price could be on the brink of an explosive increase. Monetary policies, particularly those enacted by the Federal Reserve and other central banks around the globe, play a significant role in the valuation of precious metals. These policies, which include interest rate adjustments and quantitative easing measures, directly influence inflation rates, currency values, and consequently, the attractiveness of investment assets like silver. In a world where interest rates are low, traditional savings vehicles offer meager returns, pushing investors to seek alternative stores of value. Silver, much like gold, benefits from this shift, as it is seen as a hedge against inflation and currency devaluation. When central banks signal a dovish stance, lowering interest rates, or implementing measures to stimulate economic growth, precious metals typically see an uptick in demand. The anticipated interest rate cuts, hinted at to possibly start in mid-2024, are particularly noteworthy. Such cuts would decrease the opportunity cost of holding non-yielding assets like silver, making it more attractive to investors. This expectation is not merely speculative. It's grounded in a detailed analysis of current economic indicators and policy trends. Lower interest rates tend to weaken the currency, in this case, the US dollar, further enhancing the appeal of silver as an investment. Furthermore, these monetary policies are enacted in response to broader economic conditions, including inflation. As inflation erodes the purchasing power of currency, the inherent value of tangible assets like silver becomes more pronounced. Silver not only serves as a store of value, but also plays a crucial role in various industrial applications, adding to its demand in times of economic expansion or green technology advancements. This delicate balance between monetary policy and precious metals investment is a dance of economics, where each step by central banks is closely watched by investors. The current trajectory suggests a potentially more favorable environment for silver investment as we move forward. With the Fed expected to signal further and accelerated easing in the coming year, the groundwork is being laid for an environment where silver could shine even brighter. In summary, understanding the impact of monetary policies on silver is crucial for investors. It's not just about reacting to current conditions, but anticipating future movements. As we navigate through this chapter of economic policy, the potential for silver to benefit from lower interest rates and increased investor demand becomes clear. This is a key piece of the puzzle in forecasting silver's price trajectory, offering a compelling reason for investors to closely monitor policy developments as they unfold.
This is taking full delivery, large amounts in the silver. The silver level on the COMEX right now is at record lows, and in London and in New York, so there's simply not enough supply there to meet the demand and the deliverables. Once hard assets that are highly levered to short the markets in the past leave the COMEX, they don't come back in very easily. And so I think when you break a technical line of resistance on the spot price, at the same time that the COMEX in the London markets are running out of physical assets to manipulate those markets, at the same time that central banks and more shadow banking or shadow advisors are buying physical gold and paper gold, it's getting harder to manipulate that price. I wrote an article a few months back too, or a few weeks back, just about the fact that now you have a Shanghai gold exchange, you have a Shanghai oil market, you have a Shanghai gold market. We're going to see the same thing in Russia with the Moscow World Standard. All this post 2022 sanctions, you can't have 3 different gold markets and only have one manipulating them. So the power to manipulate precious metals in the past is slowly but steadily changing. The outflows out of the COMEX and the LBMA banks and the London exchanges is historical. It's literally historical. So that, in a combination with the technical signals we're seeing when you break resistance, you'll see higher highs and lower lows. You'll see less ability by the usual suspects to manipulate the paper price, which we all know happens. There's some who argue that that's not true. It's simply undeniably true. And at the same time that the COMEX and the silver markets and the gold markets in London and New York are running out of literal physical ammunition, they're also having to worry about manipulating the Bitcoin price through, the new ETFs there and the spot price Bitcoin ETFs and the mining games that they're playing with Bitcoin. So they've got these 2 anti-fiat powerhouses, precious metals and now Bitcoin. They've been able to regulate gold for years through the LBMA markets and the OTC markets and the COMEX in New York and London. Now they're trying to put their attention towards Bitcoin, which they'll probably manipulate and keep range bound. I don't think they'll be able to keep gold and silver as range bound as they have. And so, another long answer to a short question, the combination of the technicals and the fundamentals we talked about, as well as what's happening in the COMEX and LBMA banks and exchanges, is converging in a powerful way. At the same time, the debt levels are rising, nearly $9 trillion in U.S. treasuries have to be coming to maturity this year, that there's going to be more obvious synthetic liquidity, that there's more stress in the credit markets, that we are seeing a recession all over the world in some of the largest economies, including Germany, and the gold price is rising. So I think it will be an arm wrestle to 25, and then it'll get past 25. And again, it's because the currencies are going to get weaker and the system is cracking that gold is going to get stronger. As Rick Rule has said, and I've always said, and Egon has always said, we're glad to see gold rise. We're not surprised to see gold rise. It's going to be a sad day for the rest of the world as gold rises, but the prices of things are going to rise. And if wages don't keep up, they can manipulate inflation. But the simple thing is, when gold's at 2,500 or even 5,000, we'll be glad we have it to protect the obvious dilution of our purchasing power of our national currencies, but everything's going to cost more too, and people are going to be suffering more. But for those, who played the long game here, this isn't an I told you so moment. This is something we've been seeing for.
As we approach the latter stages of our exploration into silver's potential surge, we'd encounter global shifts and de-dollarization efforts that underscore the strategic importance of silver, not just as an industrial metal, but as a key player in the broader monetary landscape. Global shifts towards de-dollarization reflect a growing trend among nations and large financial institutions to diversify away from the US dollar. This movement is not merely a financial strategy, it's a reflection of changing geopolitical dynamics and a desire for economic independence and stability. As countries and institutions look to hedge against the volatility of fiat currencies and the political uncertainties that come with them, precious metals like silver stand out as attractive alternatives. Silver, with its intrinsic value, serves as a reliable store of wealth in times of currency devaluation and economic instability. Its role is further amplified by its industrial applications, particularly in sectors driving the future of energy and technology. The push towards green energy and electrification, for example, underscores silver's indispensable role in solar panels and electric vehicles, adding a layer of demand beyond its monetary appeal. The strategic accumulation of silver and other precious metals is part of a broader trend towards asset diversification. This trend is fueled by concerns over the long-term viability of fiat currencies, which have been subjected to unprecedented levels of printing and debt accumulation. In this context, silver's appeal is twofold: as a hedge against inflation and currency risks, and as a critical component in emerging technologies that are pivotal to global economic growth. Moreover, the de-dollarization effort is indicative of a larger shift towards a multipolar world order, where economic power is more evenly distributed among nations. This shift encourages the exploration of alternative reserves and investments, with silver playing a crucial role in this diversification. The metal's dual utility as both an investment and an industrial commodity makes it uniquely positioned to benefit from these global trends. Understanding the implications of these global shifts and de-dollarization efforts is crucial for investors looking to navigate the evolving economic landscape. Silver's potential surge in value is not just about market dynamics. It's deeply intertwined with geopolitical movements and the strategic decisions of nations and financial institutions. As we witness these global shifts unfold, the case for investing in silver becomes increasingly compelling, not just as a defensive measure but as a proactive strategy to capitalize on the changing tides of the world economy. In this era of transformation, silver emerges not just as a precious metal, but as a cornerstone of future economic stability and growth. Its role extends beyond traditional investment paradigms, offering a bridge between monetary security and the technological advancements that will drive the next phase of global development. For those looking to the future, silver represents an opportunity to align with the forces shaping the new economic order.
If you're chasing these tops, by the way, there's never been a higher point in our history where insiders are dumping their stocks at the tops. It's not just Bezos. These are smart guys. They're not in it for social justice. They're not in it for the rest of the world. They're going to get out. They're going to pump up and spoof the markets up. They're going to take this FOMO on the profits. They're going to get maximum valuation when they exit quietly. And the retail plankton will chase those tops. But unlike a lot of hedge funds and sophisticated traders, the retail investors that are building this bubble won't know what signals to follow when it's time to get out. And when that liquidity need is there, when you need to get out, the exit door will be the size of a mouse hole. And a lot of retail investors are going to get spanked. And, again, this faith in AI, this dystopian faith in technology, this idea that's been pandered, I guess I keep thinking of the Theranoses of the world, the Adam Newmans of the world, the Sam Bankman-Frieds of the world, the Mark Zuckerbergs of the world, the former heroes that we thought, or again, Adam Newman, Sam Altman today. These young Turks are just young turkeys. They're not in it to make America a better place for the middle class or for retail investors. They're in it for themselves to spoof, pump, dump, and stay in business. And so this market bubble literally couldn't come at a worse time because it is too concentrated. There's not enough companies behind the Magnificent Five to keep the S&P up. So that's, again, part of the reason you're seeing gold and precious metals.
As we navigate the transformative landscape of investment, the spotlight increasingly turns towards precious metals, marking a significant shift in the investment landscape. This evolution isn't just about diversifying portfolios. It's a strategic pivot towards assets that offer both stability and growth potential amidst economic uncertainties. Silver, with its unique blend of monetary value and industrial utility, stands at the forefront of this shift, drawing attention from a diverse range of investors. The investment landscape is undergoing a profound transformation, driven by macroeconomic factors, technological advancements, and changing investor sentiments. Traditional investments in stocks and bonds, while still central to many portfolios, are being complemented with alternative assets that can hedge against inflation, currency devaluation, and economic downturns. Precious metals, especially silver, are increasingly recognized for their role in this diversified investment strategy. Silver's appeal to investors extends beyond its historical role as a store of value. Its widespread use in various industrial applications, particularly in areas pivotal to the green energy transition, such as solar panels and electric vehicles, adds a layer of demand that is relatively insulated from the volatility of financial markets. This dual demand, investment and industrial, positions silver uniquely within the broader spectrum of investment options. Moreover, the growing interest in silver and other precious metals is reflected in the actions of investment funds and respected financial analysts. These entities, which play a significant role in shaping market trends and investor behavior, are turning to silver not just as a defensive play, but as a strategic asset with potential for significant returns. Their endorsement and allocation to silver signal a broader acceptance and recognition of its value in a well-rounded investment portfolio. This shift in the investment landscape is also influenced by the increasing availability of information and resources that allow investors to make more informed decisions. The rise of online platforms, financial news outlets, and social media has democratized access to investment knowledge, enabling a wider audience to understand the benefits of including silver in their portfolios. The transformation of the investment landscape underscores a collective movement towards assets that offer resilience in the face of economic challenges, while still providing opportunities for growth. Silver embodies this dual appeal, making it an increasingly attractive option for those looking to navigate the complexities of the modern financial world. In summary, the evolution of investment strategies towards precious metals, particularly silver, reflects a broader trend of seeking stability, diversification, and growth. As the investment landscape continues to evolve, silver's role as both a monetary asset and an industrial commodity positions it as a key player in the portfolios of forward-thinking investors. This strategic shift not only highlights the growing importance of precious metals in modern investment theory, but also underscores the dynamic nature of market responses to global economic trends.
Look, there's always been a warning. I've always said that gold can be very sympathetic in the first 10 minutes of a market meltdown, especially after a large melt up. We've seen it. I've seen it in the gold markets. I've also just seen it as a risk asset manager when you're getting the phone calls. People and funds need liquidity when the risk asset portfolio is getting spanked. And so they can get instant liquidity by converting their gold into a currency at that time to cover margins or to cover losses. And so it's very often the case where you see a temporary pullback in the gold price after a significant meltdown following a melt up. And that pullback doesn't last very long. It's a great buying opportunity. You could argue now that it will be somewhat different in the next meltdown, that gold may not be sympathetic down for very long or at all, because there is such a limited supply of the actual physical gold that it will be carried more carefully and held more tightly in the next major drawdown. Again, when you see JP Morgan stacking gold, when you see central banks stacking gold, when you see private investors holding onto it carefully, it'll depend on how over their skis individuals, certain shadow banks, certain funds, and certain institutions and certain central banks are when that moment comes, how prepared and liquid they are outside of their gold holdings. Because there is a risk that there'll be a pullback. That isn't, to me, a buying opportunity. I wouldn't count on that as a pullback to buy. In this particular macro environment, in this debt environment, in this very carefully held demand now for physical gold in a very limited supply, I wouldn't rely on that as a pullback opportunity. Again, compared to the broad money supply, gold today is as cheap as it was in 1971 if you get it before everyone else wants it. Now everyone else really wants it. And what we're seeing on these New York and London exchanges is they want it. And they don't just want it because they want to buy Bitcoin. They want it because they want it. They need it as a hedge against a national currency like the US dollar, despite all its power sources and despite the milkshake theory, for which I have a tremendous respect. The simple fact is the world knows that this tier one asset of gold is a better tier asset than the U.S. Treasury, and that U.S. Treasury is married at the hip to the U.S. dollar. And since 2022 and the sanctions against Putin, whatever you think of that war, whatever you think of Putin, the fact that we weaponize the world reserve currency, there's no doubt that the trust in that dollar has changed dramatically. And the need for gold has risen dramatically. And that these new all-time highs will not have the same susceptibility to manipulation like they did in the past by a COMEX that has been neutered of its physical supply, and the London exchange has been neutered of its physical supply at the same time that the Shanghai and Moscow exchanges are now rising in influence and power as the BRICS gain more power post-weaponization of the US dollar in 2022. They're all related. It's alles ist verbunden, as we say. It's all connected. It's no longer the gloom and doom narrative that they used to say about gold bugs in the past. None of us have been gold bugs. All of us were in risk assets. All of us understand credit markets and equity markets. We didn't come to gold to make speculation. We came because we saw the slow death of the U.S. currency and the open desperation of.
In this final stretch of our journey exploring silver's potentially explosive future, we synthesize the insights and factors that make a compelling case for its unprecedented ascent. This isn't just another chapter in the history of precious metals. It's a forecast grounded in the interplay of economic indicators, market dynamics, and global trends that point to a significant rally for silver. The anticipation of silver reaching heights of $2,500 and beyond is rooted in a multifaceted analysis of its current standing and future prospects. This potential surge is not merely speculative. It's based on a logical and informed assessment of several critical factors. Industrial demand. Silver's role in the burgeoning green technology sector, particularly in solar panels and electric vehicles, underpins a robust demand that is expected to grow. This industrial offtake, driven by global shifts towards sustainable energy, provides a steady floor for silver's value, with potential for significant upside as these technologies gain wider adoption. Monetary policies and economic instability. The global economic environment, shaped by central banks' monetary policies and the specter of inflation, creates a fertile ground for precious metals to thrive. Anticipated interest rate cuts and ongoing financial uncertainties bolster the appeal of silver as a hedge against currency devaluation and inflation. Supply constraints, challenges in ramping up silver production, whether due to geological scarcity, environmental regulations, or geopolitical tensions, contribute to a tightening supply scenario. This imbalance between growing demand and constrained supply is a classic precursor to higher prices. Investment demand, the strategic diversification into precious metals by institutional and retail investors alike, partly driven by the de-dollarization trend and the search for safe haven assets, adds another layer of demand for silver. This investment demand, coupled with industrial consumption, sets the stage for a potential price explosion. Global shifts and de-dollarization. Efforts by nations and financial institutions to diversify reserves away from the US dollar underscore a broader recognition of precious metals' value. Silver benefits from this trend, not just as an investment but as a monetary asset, reinforcing its potential for price appreciation. Technical and market dynamics. The gold and silver ratio, a historically significant indicator, suggests that silver is undervalued relative to gold. A narrowing of this ratio, as has been the pattern in past bull markets for precious metals, could see silver outperforming, further fueling its price rally. In conclusion, the confluence of these factors creates a compelling narrative for silver's future. It's a narrative that extends beyond mere speculation, grounded in tangible economic, industrial, and financial trends. For investors and silver stackers, the message is clear. The current juncture presents not just a protective measure against economic uncertainties, but a potentially lucrative opportunity. The anticipated surge in silver's value is not a guarantee, but an informed prediction based on the analysis of available data and trends. As we journey through the intricacies of the silver market, the conclusion is unmistakable. Silver stands on the precipice of a historic rally. This prospect is a clarion call to those looking to leverage the potential of precious metals in their investment strategy. Remember, the path to prosperity in the realm of precious metals is paved with knowledge, timing, and strategic action. As we wrap up our exploration, let's not forget the importance of staying informed and nimble in the face of market dynamics. The future of silver is bright, and for those ready to embark on this journey, the rewards could be extraordinary. Don't forget to subscribe for more insights and discussions that could shape your financial future. And as always, this is not financial advice, but a well-informed perspective on a rare opportunity knocking at your door. That concludes our exploration into the intriguing world of silver and its potential for unprecedented growth. Throughout this journey, we've unraveled the complex interplay of factors that could catapult silver to new heights, emphasizing its dual role as both an investment and industrial powerhouse. As we've seen, the convergence of robust industrial demand, particularly from green technologies, alongside significant investment interest, paints a bullish picture for silver. This, coupled with the challenges of increasing supply and the strategic shifts in global monetary policies, underscores the potential for silver's value to soar beyond current levels. It's important to remember that while the prospects for silver are compelling, the journey of investing in precious metals requires careful consideration, ongoing education, and a keen eye on market developments. Our exploration has provided a comprehensive view of the factors at play, offering insights that could inform your investment decisions. For those intrigued by the potential of silver, the journey doesn't end here. It's an ongoing process of monitoring, learning, and adapting to the shifts in the global economic landscape. The allure of silver, with its rich history and vital role in future technologies, continues to captivate the imagination of investors and industrialists alike. We invite you to stay engaged, stay informed, and continue exploring the opportunities that precious metals, particularly silver, offer in the quest for financial resilience and growth. And remember, the decision to invest should always be made with a clear understanding of your financial goals, risk tolerance, and the broader economic context. Thank you for joining us on this journey through the world of silver. Don't forget to subscribe for more insights into precious metals and other investment opportunities that could shape your financial future. Remember, this exploration is not financial advice, but an invitation to delve deeper into the fascinating dynamics shaping the market for silver and other valuable resources. As we part ways, let's carry forward the curiosity and strategic thinking that have guided our exploration. The world of silver is vast and full of potential, waiting for those who are ready to navigate its challenges and seize the opportunities it presents.